corporation tax is increasing. I think that was well publicised from the budget. So this video looks at how it's increasing, to the extent to which it might affect you, if we can mitigate it, how it will be implemented, and some of the more subtle points that are not really being drawn out in the main media channels. So this is a part of a series of videos I'm going to be looking over the next few weeks at all of the Chancellor's announcement, all the main things that affect small businesses, because there were a lot. So I'm going to go through them one by one. So if you'd like to subscribe to the channel, you'd be very welcome, and you'll be able to see those videos as they come on stream. And if you press the like button, it helps me get the message across. So first of all, the tax rates. So for companies, so at the moment corporation tax is at 19% for all companies. That simplicity is changing, and in the future we're going to have 19% tax for quite small companies. There's going to be a marginal rate, marginal relief. Ironically, the marginal relief means you pay a higher 26.5% tax, which I'll come on to later, and then the standard normal rate is going to be 25%. That is quite a big increase, because going from 19 to 25% is a 6% increase. 6% doesn't sound too bad, but 6 over 19, it's a 31% increase in the tax you pay. It's really substantial. But I'm more interested in how your profits are taxed with all the taxes, not just the corporation tax, for owner-managed businesses. The first slide shows you what happens with basic rate taxpayers, and I've got like 4 states of being: either self-employed, where you pay income tax and national insurance, or a company that pays 19% corporation tax, a company that pays 26.5% tax, or 25% tax. You then pay the dividend tax on what is left to give you an overall tax rate. So now you can see that a small company pays less tax than the self-employed, and then the people who pay the marginal rate and the high 25% tax. But actually, it's not much in it. It's not a huge amount. It's not going to make you rich, those sorts of differences. So the second slide, you can see what it is for higher rate taxpayers, and there you can see that when you take all the taxes together, that if you are paying the 25 or 26.5% at the margin, then almost half of your money is going in tax. So I think that'll get a few people to just think about what they're doing and why they're doing it. And actually it is lower tax for self-employed. Now that said, for self-employed people, you do actually pay higher rate tax on more, because the way it all works through, that I can't explain, but maybe it's another whole video. But basically, for each owner-director, you can put an extra £10,000 through a company before you start paying higher rate tax. So, and because in a company you don't pay higher rate tax on your retained profits, you're generally better off with a limited company if you are a higher rate taxpayer, even though it does appear at one level the taxes are lower. I don't think the blended rate is when you think of everything. So the obvious get out, if they're going to tax you on the first £50,000 at a different rate to higher rates, is, well, can you have 2 or more companies and each of them gets the same allowance, and then all will be well, and you'll be taxed at the lower rate, but you'll have the admin of lots of different companies. Well, regrettably, they've thought about that. So if you have 2 companies, you get half the allowance. If you have 4 companies, you get a quarter of the allowances. So they have definitely thought of that. So the question then is, if you've got a holding company or property company, will you actually get half the allowances? I think probably, although we haven't seen all of the legislation yet, and we don't know just what's going to be included as a company, I think from there are strands of it already in the tax system. I think it's likely that they will be included, and I have a sort of cunning plan to make sure that for our clients, I think you need to really think about how you're arranging your business, and it's something that I will be going through with and my team with our clients, but it has to be personal and specific, because it is something that'll need a little bit of subtlety, and I would suggest that you raise it with your accountant. But don't forget, this all comes into effect in 2 years' time. So although yes, it is something we need to think about, it's important but not urgent. I then want to talk about pensions. So with pensions, for a normal limited company, if you're a basic rate taxpayer, then you pay tax at 25.1% if you take all of the taxes into account. Now, when you put your money into a pension, when you take it out when you retire, I'm assuming you're a basic rate taxpayer, you get a 25% tax-free lump sum. So your blended rate of tax on your pension income is 15%. And I've always thought it's a bit marginal if you're going to save 25% to then pay 15%. There's a 10% tax saving. I've never been quite convinced that that's worth it, given the restrictions you have once the money goes into your pension. It's very different if you're a high rate taxpayer. It's definitely worthwhile in most circumstances if you're a high rate taxpayer. So now that the rates of tax have increased, that sort of dynamic changes a bit, and I think even for basic rate taxpayers it's much more worthwhile using pensions to shelter your income from tax. I think also, one of the subtle things that you might, when we change, is that actually if you delay your pension payments until the new tax rates come in, you will actually save more money on your pension. So that's a thought, but I think in terms of putting money into your pensions, that's a complex area, so it's something that you really need to think through with care and with your advisors, and this obviously can't be advice because it's not personal. Interestingly, interest and rent are now just taxed without national insurance, so they're taxed at 20% and 40%, which is actually much lower than any other sort of tax, which is peculiar if you're a child of the 70s and you remember that unearned income back in the day was taxed very, very highly. But they are taxed low, and so if you do have what could be considered interest or rent in your limited company, you have assets that where you might be charging rent, then having rental income and interest income just became that bit more useful. So I think that's a thought for if that applies to you. One question that we get asked quite a lot is, what salary should a director of a limited company take? Now, it's been my view for quite a long time now that the best salary is £12,500 a year. There can be tiny savings if you pay yourself a bit less than that, but I've never thought they were big enough to less than £100. They're really small. But I just like, if £12,500, that's £1,000 a month you get from your company as salary, and that just makes sense in my personal finances. And if you're a husband-wife team, then each of you getting £1,000, £2,000 into your personal accounts, it's material and it sort of makes sense just at a basic level. And there are peculiarities in the tax system where it can help. With the new tax rates, if you're paying 26.5% of the margin corp tax or 25% corp tax, then definitely paying yourself £12,500 a year, subject to all the normal caveats. It's a very personal decision. Does make a whole load more sense, and more sense than it used to, and it's something that I thought was a sensible idea in the first place. Tax is increasing, and we don't like that, I guess. As owners of businesses, we don't like paying more tax. It's not pleasant, and 31% increase in tax is substantial. And I think that that really will make us look at the main mitigations that are normal now. I never advise people to do aggressive tax planning. I think aggressive tax planning is a bad idea. However, we do need to make sure that we're doing the basics. So doing the basics means making sure you have got the right salary for yourself, that all members of the family that could take income if it's appropriate and they do the right amount of work. Then are the members of the family that have the appropriate amount of income, making use of pensions, R&D, tax credits. Electric cars are very popular, or vans at the other end, and taking advantage of little things, you know, just to make sure you claim all of the expenses that you can within your business. When the tax rates go up, then being really focused on your expenses makes more sense. Now, I did say that I'd explain the 26.5% tax rate and why I think that is the case. Now, I'm not sure I can explain it really simple on a video. I do have a working example that if you give me your details, I will send it out to you, and don't worry, I won't spam you with a whole load of emails. I will send you something, but it is quite difficult to explain, but I'll have a go. So the 26.5% tax between £50,000 of profit and £250,000 of profit. Basically, the way it works is that if you've got £50,000 of profit, you're taxed at 19% on all of that money. If your profits are £250,000, you're taxed at 25% on all of that money. Well, if you're taxed at 19% on the first £50,000, you have to be taxed at more than 25%, which actually works out at 26.5%, between £50,000 and £250,000, in order for there to be a smooth transition, so that when you arrive at £250,000 of profits, you're taxed at 25%. So if you are between 50,000 and 250,000, your overall tax that you pay for all of your income is less than 25%, but at the margin for each extra pound that you earn, you're taxed at 26.5%. Now, I can show you an example of how it works in practice, but as I say, it's really hard to do just on a video, because we need to, you know, look at a spreadsheet. So there you are. Tax is going up, and I wanted to explain how it works, what the blended tax rates are, how we can think about mitigating some of that, how the change gives us an opportunity to pay our pensions a little bit later and stuff like that. So I've tried to summarise that. If you've got any questions, then please ask me. If you're a client, you know where we are. If you put some comments down, I will answer them as soon as I can. If you want to hear more videos about the Chancellor's Budget and then tax and accounting as we go along, then please subscribe to the channel and I'll keep you up to date. If you press the like button, it really helps the channel to get out there. Thank you for watching.